18 months after charging thousands above sticker for its hybrids, Toyota is now flooding showrooms with the lowest APRs and juiciest rebates in company history. Tacoma and Tundra hybrids are offered at rates under 3%, Prius leases are below $260, and cash incentives are stacking on top. These are discounts the market did not expect. This is the brand famous for holding the line, now flipping to desperate deals across every hybrid at once. Why did Toyota hit the panic button, and what broke their hybrid stronghold so suddenly? The answer unravels a multi-billion-dollar predicament nobody saw coming. Dealer ads now shout numbers that would have seemed impossible a year and a half ago. Across the country, Toyota's official lease tables and showroom banners spell out the new rules. $209 a month for a 2026 Corolla Hybrid LE, with $3,999 due at signing. A Prius LE all-wheel drive, once nearly impossible to find below sticker price, now leases for $259 a month, less than the average compact SUV payment from just last year. Financing offers tell the same story. Buyers of the Corolla Hybrid see 4.99% APR for 72 months. The Prius plug-in hybrid drops even lower, with a 3.99% rate stretched over 6 years. For those eyeing an SUV, the RAV4 Hybrid lease clocks in at $319 a month for 36 months, and returning Toyota lessees get a $1,000 loyalty rebate on top. Highlander and Grand Highlander hybrids offer 4.99% APR for up to 72 months, with leases from $439 to $569 a month, depending on trim. These deals are not limited to a single model or region. Nationally, Toyota has synchronized cash rebates and APR offers across nearly every hybrid in its lineup. College graduates and military members get another $500 off. Loyalty discounts stack with cash and low-rate financing, sometimes bringing the total incentive package near $2,000, even before dealer-level markdowns. This is the same Toyota that, just 18 months earlier, saw dealers adding $5,000 to $10,000 above sticker price for the RAV4 Hybrid and Camry Hybrid. Inventory shortages led to waiting lists and buyers paid premiums just to secure a build slot. Now the tables have turned. Instead of markups, buyers see rebates and rates that rival the most aggressive deals in the industry. The contrast is sharp. Where once a RAV4 Hybrid meant a months-long wait and a price well above MSRP, today's buyer can walk in and leave with a new lease, a stack of rebates, and a payment hundreds lower than last year's average. Toyota's reputation for holding value and resisting incentives has given way to a wave of across-the-board deals. The question is clear: low annual percentage rates, monthly payments well below national averages, and stackable cash rebates, all at a moment when other brands are still inching up prices. What forced Toyota to abandon its old playbook and flood the market with these offers all at once? The answer lies deeper than showroom banners, and it is reshaping the hybrid market for everyone. Toyota's product roadmap told a story of confidence until the market changed around it. In 2025, the Camry became a hybrid-only sedan across the United States. No more gas-only option, no fallback. The Corolla lineup followed, with hybrid and plug-in versions taking center stage in dealer showrooms. By early 2026, the RAV4 joined them. Every new RAV4 sold is now either a hybrid or a plug-in hybrid. For years, this strategy looked unbreakable. Hybrids gave Toyota an edge on efficiency without the range concerns of full electrics. Dealers could count on steady demand and strong resale values. But the timing of those shifts left Toyota exposed. Just as the company doubled down on hybrids, the underlying rules of the market began to change. Competitors began to ramp up their own hybrid lines. Honda, Hyundai, Ford, and GM moved quickly. Suddenly, Toyota's near monopoly on affordable fuel-saving vehicles vanished. Where buyers once saw Toyota as the only practical hybrid choice, they now found alternatives at every major dealership. The vulnerability map breaks down by segment. Trucks, once a fortress for Toyota, now show vulnerability. The Tundra Hybrid and the new Tacoma Hybrid face direct competition from Ford's F-150 Hybrid, a truck with aggressive pricing and deep brand loyalty. In sedans, the Camry and Corolla hybrids must defend territory from the Honda Accord and the Hyundai Sonata hybrids, both priced to challenge Toyota's value. Even the Prius, long the face of hybrid technology, finds itself in a crowded field, with incentives needed just to hold its ground. SUVs, especially the RAV4 and Highlander, still draw loyal buyers, but the shift to hybrid only for the RAV4 in 2026 means Toyota cannot lean on a lower-priced gasoline version to pad sales numbers. The Highlander Hybrid faces pressure from new entries by Hyundai and Ford, both offering spacious crossovers with competitive fuel economy and attractive lease deals. With every segment now contested, Toyota's strategy depends on keeping hybrids attractive at the checkout counter. That is where the discount tiers come in. Trucks receive the most aggressive rates, sedans follow, and SUVs receive competitive but slightly less generous offers. Those tiers reveal where Toyota feels most threatened and where it is willing to sacrifice margin to keep buyers from defecting. This all-in bet on hybrids, once seen as a safe hedge, became a gamble as soon as demand softened and rivals closed the gap. The simultaneous rollout of deep incentives across every major model highlights how defensive this play has become. For Toyota, maintaining sales velocity is not just about moving metal, it is about protecting market share before the financial math turns against them. Toyota's latest financial results reveal the scale of the problem hiding behind the showroom offers. In the second quarter of fiscal 2026, the company reported operating income of 2,005.6 billion yen, a drop of 18.6% year-over-year. Automotive operating profit fell even further, down 26.6%, as sales revenue in that segment slipped by over a quarter. Guidance for the full year was revised sharply downward, now standing at 3.4 trillion yen, about $21.7 billion. The numbers are clear. Toyota's profit machine, long the envy of the industry, is sputtering under new pressure. A closer look at the earnings breakdown shows where the money went. U.S. tariffs now figure as a major expense, with the company's own filings listing them alongside rising material costs and currency swings. Analysts estimate the tariff burden alone approaches $3.3 billion per quarter. Spread across Toyota's global production target of 10 million vehicles for 2026, that adds roughly $330 in extra cost to every unit sold. This is not a one-time hit. It is a structural cost that Toyota must absorb or pass on, model by model. Tariffs are now a central driver of the shortfall. The math behind the incentives starts here. Historically, Toyota's average contribution margin per vehicle ranged between $1,500 and $2,500 before incentives. Now, with stackable rebates and ultra-low annual percentage rate financing, that entire cushion is at risk. A $1,000 cash rebate paired with a 4.99% annual percentage rate. When market rates hover closer to 7%, can easily add up to $2,000 or more in lost margin per vehicle over a standard 60-month or 72-month loan. For some models, the total incentive package approaches the $2,500 mark, effectively erasing the profit Toyota once counted on with every hybrid sold. Margin pressure is now visible on the transaction level. A sell-side auto analyst describes the situation in stark terms. Toyota's discipline was legendary. They almost never blinked on price. When incentives stack like this, it is not about gaining share. It is about plugging a hole. Every $2,500 in discounts is a direct concession to margin pressure from tariffs and softening demand. Discipline has given way to defensive pricing. A tariff policy expert adds context. The U.S. tariff regime hit Japanese automakers hardest. When you layer that on top of a strong dollar and higher commodity costs, even a company as efficient as Toyota faces a squeeze. The only lever left, if you want to keep volume, is to sacrifice margin. The result is a strategic trade-off where volume is preserved at the expense of profit. The waterfall effect is visible in the company's own financial slides. Tariffs, foreign exchange, and materials each pull down operating income by hundreds of billions of yen. Cost-cutting and expense reduction efforts only partially offset the losses. The result is a 37% drop in quarterly operating profit compared to the previous quarter, and a full-year outlook that is $4 billion lower than just a year ago. The drop is dramatic and measurable. For Toyota, the equation is unforgiving. At a $2,500 margin per vehicle, a $330 tariff hit wipes out more than 10% of the cushion. Stack on incentives, and the margin can vanish entirely. To recover lost profit, Toyota would need to sell as many as 1.3 million additional vehicles globally, or raise prices on every car, an impossible task in a market already pushing back on affordability. The incentives now flooding showrooms are not a marketing flourish. They are the visible symptom of a deeper financial reckoning, one that links every rebate and annual percentage rate offer directly to the company's bottom line. Residual values for Toyota hybrids have started to slide, catching both dealers and current owners off guard. The Mannheim Used Vehicle Value Index, a key barometer for the industry, shows a 10 to 15% drop in hybrid residuals over the last 12 months. For a RAV4 Hybrid or Camry Hybrid, that means thousands of dollars in lost equity for anyone trading in or coming off lease. The same vehicles that once sold at a premium now face a double hit, lower resale prices, and new car discounts that drag used values down even further. On dealership lots, the impact is immediate. Inventory that once turned in weeks now sits for months, especially older trims and 2025 carryovers. Toyota's national inventory, up more than 44% year over year, has left some dealers holding more than twice their usual supply. With the 2026 models arriving and retooling for the redesigned RAV4 causing supply hiccups, dealers face a mix of slow-moving hybrids and sporadic gaps for the most in-demand specs. The result is a patchwork of incentives, aggressive markdowns on 2025 models, especially for less popular trims, and quick deals for customers willing to take what is on the ground. Floor plan financing costs weigh heavily on dealer operations. With new vehicle inventory across the industry hitting 3.2 million units by mid-January, and Toyota's own lots swelling, the cost to simply store unsold vehicles, often at interest rates above 7%, eats into already thin margins. Dealers report paying hundreds of dollars per vehicle each month just to keep cars on the lot. For group general managers, the math is unforgiving. Last year, we could turn a RAV4 Hybrid in under 2 weeks. Now I have rows of them aging out, and every day costs us more in floor plan. The rebates help move metal, but we are writing down trades and used inventory to keep up. Certified pre-owned hybrids, once a fast-turn profit center, have not escaped the pressure. Toyota's certified pre-owned finance offers, 4.49% APR on used hybrids, are less generous than new car deals, making it harder to justify higher prices on the used side. As new hybrid incentives climb, dealers must lower asking prices on used inventory to keep buyers interested, accelerating the erosion of residuals. The knock-on effect is clear. Owners coming off lease find themselves with less equity, while dealers accept slimmer profits or even losses to clear space for incoming models. This environment creates a sense of urgency among dealership staff. The push to clear 2025 inventory before more 2026 hybrids arrive is relentless. For some, the only way out is to stack every available rebate, cut trade-in values, and accept that profit on the next sale may be measured in single digits. The window to move aging inventory is closing fast, especially with factory retooling slowing the pipeline for certain models. Dealers know that if they do not act quickly, they risk being left with unwanted stock as consumer interest shifts and as competitors ramp up their own incentives. On the ground, Toyota's discount strategy is less about generosity and more about survival. For every rebate offered and every low APR deal signed, there is a spreadsheet in the back office showing just how much margin is being sacrificed to keep the wheels turning. The race to clear lots is on, and the clock is ticking before external threats, especially from Chinese electric vehicle makers and aggressive hybrid launches from Honda, Hyundai, and Ford, make the squeeze even tighter. This is not a marketing promotion. It is a sales operation designed for survival. Chinese automakers have rewritten the playbook for global electrification. In Europe, their electric vehicles captured nearly a quarter of the electric vehicle market in 2025, up from just 8% 2 years earlier. Industry forecasts now put their share at 25% or higher for 2026, despite new tariffs and regulatory hurdles. Leapmotor, a brand barely known outside China a few years ago, delivered almost 240,000 vehicles in 2025 and is aiming for 500,000 this year. BYD, NIO, and XPeng are moving even faster, with BYD alone topping 4 million global deliveries last year and expanding European sales with models like the Auto 3 priced well below Toyota's RAV4 Hybrid. The impact is not limited to Europe. North American automakers are scaling up hybrid production across every major segment. Ford's F-150 Hybrid, Honda's Accord and CR-V hybrids, and Hyundai's Ioniq models have all arrived with competitive pricing and features. The result is Toyota's longtime advantage in affordable, fuel-efficient vehicles rapidly eroding, as rivals flood the market with alternatives. An independent China electric vehicle analyst sums it up. Chinese brands are no longer just low-cost options. They are setting the pace on price, battery technology, and digital features. For Toyota, this means hybrids are now commodities, not crown jewels. The only way to compete is to match the price floor set by these new entrants. The scale and speed of this competition force Toyota's hand. Deep discounts are no longer a choice. They are the cost of staying relevant in a market where yesterday's hybrid premium is today's baseline. Toyota's incentive bulletins now reveal an even starker contrast between hybrids and full electrics. While hybrid buyers see rates as low as 3.99% and cash back up to $1,500, those choosing a BZ all-electric model are being offered 0% annual percentage rate for up to 72 months and as much as $6,000 in direct cash incentives. In some regions, a new BZ4X buyer can combine a $3,500 loyalty bonus with zero interest financing, an offer that eclipses the hybrid deals by thousands of dollars over the life of a typical loan. For shoppers doing the math, the difference is real. A buyer comparing a 2026 Prius plug-in lease at $259 a month to a BZ4X with $6,000 off and no interest can see their monthly payments drop below what a comparable hybrid would cost, even before accounting for fuel savings. One recent customer, weighing a RAV4 Hybrid against a BZ4X, calculated a total savings of nearly $4,500 over 3 years by switching to the electric vehicle, enough to offset the higher sticker price and erase most of the charging anxiety. Toyota's management has described these incentives as a necessary step to clear hybrid inventory and accelerate the transition to full electrics. But the window is narrow. Most offers expire within weeks, and dealers warn that once inventory normalizes, these discounts will vanish. For buyers, this is a rare moment when Toyota's strategic urgency translates into real structural savings, an opportunity unlikely to return as the company pivots to its next phase. Today, Toyota's discounts aren't a sign of generosity. They are a signal that the hybrid era's safety net is fraying under global pressure. As rivals multiply and tariffs bite, no brand remains immune to the laws of competition. For buyers, the window is real. For the industry, the message is clear. Dominance is always temporary. What happens next will redefine the road ahead. Share your thoughts below.